On today's show, 4 questions. We're starting with the bonus one. Who is Pesto? Number 2, is it a little too quiet? Number 3, why does everyone feel poor? And number 4, what can Roger Federer teach us about stocks? Welcome to Dentist Money's 2 Cents, where we help dentists navigate all the noise. I'm Matt.
I'm Victoria.
And I'm Rabih.
Yeah, you are, Rabih. Yeah, you are.
You should have whispered the second question, like, is it a little too quiet?
I should have. You're right. Maybe I'll go back and do it again. No, I won't. We're just going to move on. But that would have been a good suggestion before we started.
It's not like we yapped for 10 minutes before we pushed record.
We always do. Good
Yes.
thing that those conversations are not recorded, because it would never get posted. Not that we're
That's
saying
for
anything.
our paid subscription.
Exactly. That's for the paid DA after hours. Let's jump in with the bonus question. Victoria, you were extremely excited about this. Tell us, who is Pesto?
Well, okay, first off, you already know, but Rabih doesn't. Rabih, any guesses?
No, for me, pesto is food.
Yeah.
Sure. Okay, so I have something to announce. If people haven't heard already,
Pesto's good, by the way.
Pesto is amazing.
It is good.
Should we pause there? Did you need to talk about that for a second?
No, I just wanted to address it. Pesto is good. Yeah.
Oh, it's
Anyway,
great. You can
move on.
buy like a pretty decent sized package at Costco for like $11. It's amazing. Anyways, Pesto is the largest penguin ever born in captivity, and he's currently at the Melbourne Zoo, and he's become an internet sensation. Anytime I go on TikTok, it's just Pesto, just this massive king penguin. So for some context, he's more than twice the weight of both his parents combined. He's a 52-pound, 9-month-old
I feel that,
king
Pesto.
Yeah.
Yeah.
Yeah, so that's all. If you haven't heard of Pesto, you have to, like, if you're not, you need to go look him up right now. That's the most important thing of your day today is
Okay.
Googling Pesto, the king penguin. He's massive.
I feel like I was the Pesto of babies. I was 11.5-pound baby, so
Good Lord.
I feel like I was the Pesto of babies. Anyway, Rabih, go ahead.
Why is he called pesto? Like, he's not
That's
green.
just his name.
It's a great name for a penguin, if
Rabih,
you're being
not
honest.
everything is-
Penguin?
Pesto the penguin? That's pretty dope, dude. I mean, this penguin probably should have been named something different, like Pudgy or something.
Fettuccine Alfredo or something.
Maybe Pudgy the penguin. Either way.
Yeah.
We felt we needed to give this to Victoria. Thank you so much for
Thank
letting
you.
us digress to start this.
Mhm.
You were feeling a bit pent up. If you don't talk about animals at least once a month,
I'm a huge
you
animal
get a little
lover.
angsty.
Yeah, wasn't I just talking about Kelly the dolphin like a few
Yes.
episodes
Yes,
ago?
I'm saying.
Here
So
I am
we need to
saying
give
Pesto the
you
penguin.
we need to give you at least once every month or so an animal spot on somewhere in our content. So
We're working on a National Geographic sponsorship very
yes,
soon.
we
Guys,
are. Yeah.
If I got sponsored by Natty Geo, oh my God, that'd be a dream. Like the literal retirement dream for me is being a expert birder for National Geographic.
Okay, first of all, no one
I'd
calls
win.
it that. But either way, nobody called. You made that up on the spot. Okay.
I did.
So let's jump into the actual topics. We do appreciate that. Everyone go Google Pesto. I did see him. He is a monster penguin. It's
Big boy.
insane.
Yeah.
So, okay. Moving on to the actual stuff. Rabih, is it a little too quiet? Was that better?
That was really good.
Is it a little too quiet, Rabih? What do you mean by that?
What say ye?
What say ye, Rabih?
So lately in the market, the last week, I would say, since the Federal Reserve met, anytime we get news, the market seems like it doesn't care, which is something amazing. Like the news that is coming up, new information being incorporated into prices is not causing big of a swings. And usually for people who want to look at the market every single day, like I do, it's like, this is quieter than usual, but this is how we would want it to be. It's just that we've been in a period of no quietness or loudness for so long that we forgot how quiet it should be. And here's what I mean by that. Usually data comes in with a price impact and moves the market when there are two opposing trades in a sense to it. So the biggest example, which I want to allude to, is the different expectations of the Federal Reserve versus market participants. For a good while now, right before this interest rate cut, the market was with a disagreement with the Federal Reserve on what they think the proper path of rate cuts going forward is going to be. And because the market was like pricing in a 50 basis point, where the Fed's initial communication was 25 basis point, etc., all through what we think the terminal interest rate is going to be by the end of 2025, any new piece of information was getting interpreted differently by market participants. Those who are on the Fed side versus those who are on like what the futures are saying. Because of this different positioning, the intention of those market participants were different, and thus the trades at which they execute their transactions were different. So every piece of information, whether it was a new reading for inflation or a new reading for unemployment, was being traded with kind of non-verbal disagreement. Like, this is what we think the true value of is happening. And because of this trading activity, this creates a little bit of swings up and down. This is all noise. And this is what we mean, like, let's navigate all the noise when we wonder why the market moved 1% or 2% in a day. And we're just saying it's noise just because we have two participants or two major narratives affecting participants in the market differently. Since the Federal Reserve issued their summary of economic projections last week, they kind of, and we talked about it, the Federal Reserve went on and said, oh, this is what the current unemployment, let's set that as our target. That's where the GDP is growing at, let's set that as our target. And in a sense, they reconciled and eliminated that gap in expectations. The two narratives became one. And the Federal Reserve and market participants are kind of now looking from the same corner, in a sense. So with that, we actually notice a disappearance of major swings in the market. We haven't seen a 1+% move since before the meeting. So when we're saying, oh, is it a little bit too quiet? It's just that there are no opposing trades as much, but the information is still coming, and now the market is being as efficient as it could be, churning those information that's coming in. So this brings us to the information part. So what information did we get over the last week? We actually got inflation numbers and we got unemployment numbers. So just this morning, we got the core PCE and PCE, the inflation indicators, and we know we're not going to be talking about this much going forward, and they came in line with expectations. Like PCEs growing at 2.2% year over year, and core PCE at 2.6, which is kind of a no change, no news. And previously, no news would actually create some volatility in the market, because market participants wanted to see volatility, inflation dropping, or else a certain narrative will overwhelm another narrative. Right now, because they are in line, that no news is kind of neutral to both, and the market didn't really react much to it. We're kind of flat today. But I think the important piece of information, which also, spoiler alert, didn't get any reaction from the market, was that we got unemployment numbers. So initial claims came in on Thursday, and they came in at 218,000 initial jobless claims for the last 2 weeks. Versus an expectations of 223. So a little bit below expectations, but let me give you the historical range and see, like, it places exactly in the middle. Initial claims are kind of cyclical. Around January, they spike up. They're usually in the 300,000, 400,000 level. And in the summer, where a lot of people are getting employed because the economy is booming, those drop down to like the 180,000, 170,000. So we're at 218, right in the middle, reaffirms the narrative, the joint narrative right now that is felt in the market and the Fed, which honestly, for once, is great news. Like, it's not hard to navigate the noise. There is no noise this week, and this is how an investor should be every single week. Like, instead of trying to go there and try to decipher every single piece of information, if you just not look at the market for 10 years, if you're properly diversified and invested properly, you're going to be doing as well. And this brings me to the last point. I thought, in a time when there's no news and we are at all-time highs on indices, let's look at year-to-date performance of major asset classes. And do you guys want to take a bet? I didn't post those, so you guys don't know them. What do you think the S&P is year to date so far?
Little known fact, I hate guessing games. I hate
It
them.
makes her very angry.
Like corn mazes make me so angry. I don't like being... Anyways.
We just talked about corn mazes yesterday, so I knew that.
Yeah, it's fall time, so...
Go ahead, Victoria.
19.
Okay. Matt?
I was gonna say 8, somewhere in like the 18 range.
Over under.
You guys are good. That was before this week. So as of this week, as of today, we're up 21.5% on the S&P.
Ooh, I win.
Okay.
Great year, honestly.
Yeah, not bad. Not bad. So this is the S&P 500, and let's just compare it to the other indices. NASDAQ is 19.4, Dow Jones is 14, but we know that those only look at portions of the U.S. market. So let's look at the U.S. market as a whole. The U.S. market as a whole is up 20.8% year to date. Compared to developed markets who are up 13% year to date. And kind of like the surprise of the season, because it's had a run the last couple of days, emerging markets are up 19.2% year to date.
Okay.
In line with the US in a sense. So we had a lot this year of noise going up and down, what we think the Federal Reserve's cut is going to be and when it's going to happen, along with, election season, wars happening all around the world, fluctuations in oil prices, gold getting to all-time high, but equity markets, given that business is good, an all-time high on a really healthy year, back-to-back after a 25% increase in the US last year.
Yeah.
It's looking good, guys. Ignoring the noise and just pour yourself a martini. It's great.
Yeah. Not a martini. It is interesting,
pumpkin
though.
Spice latte.
There you go. A little PSL action. It is interesting, though, because, and I think maybe I know for me, I'm a bit skewed this way because of the conversations we have all the time. It feels like in dentistry, there's just always questions around like the shiny object, right? We're always getting questions around some private investment here, there, whatever. And you guys tell me, but it feels like the stock market has just become this boring asset class that like no one, like it's just not sexy. But I want to just highlight in these moments when we look at last year and this year, knowing that again, and when we do our year-end reviews that are coming up with clients, we're going to review investment returns. We're going to be extremely happy to show investment returns. It makes it a really great conversation.
These are going to be good meetings this year.
It's going to be great meetings this year, but we also always like to highlight like, hey, this isn't going to be every year. But when it does happen, we do need to highlight like,
you guys, there's still 3 months until the end of the year. Don't
of course. There's no.
We're manifesting, Rabih. Come on now.
No, but to that point, Rabih, again, we're not saying it's going to hold, and there's going to be fluctuations. We always highlight that, but in these moments, we do want to highlight like there is no better asset class than the stock market to build your wealth, and especially in a passive way. There just isn't.
Right.
If anyone wants to make a case for me that can refute this, please do. But
there's nothing more passive than that.
There's nothing more like this is what we're going to highlight to our clients and highlight to everyone out there. That's again, assuming you are in a well-diversified portfolio focused on the long term. To that point, Victoria, though, you're right. There is nothing more passive than building that portfolio and letting it. Now, again, things have to be done with it, but it is far more passive than any other asset class that's out there. A dental practice, any private business, it's more passive than real estate. And so we just want to highlight these when you have these years, this thing works. It works.
Yeah, like your portfolio manager, Rabih, isn't going to call you up and say, hey, the water heater broke, right?
We just had our AC break at the office, right? I mean... Yeah,
they just fixed it right before we pressed record.
Yeah. So, again, Rabih, to your point, there's months left and there's going to be down years. This isn't always... We're not at all sitting here being unrealistic and saying this is to the norm. We're going to just... But you have to be able to take advantage of these years, while you can. So anything else, Rabih or Victoria, on this topic?
I think it's funny because I think when you are in this kind of environment where things are just looking good, I don't know about you guys, but I feel like people have the sentiment of just waiting for the shoe to drop. Like, it can't possibly go higher than this. I mean, we're even talking about, it might not hold. It could also keep going up between now and the end of the year. That's also a possible scenario.
Sure.
But I feel like people are kind of waiting for the shoe to drop, kind of with this idea, like, it's been so good, it has to come down at some point.
Well, this is what we do, right? To that, I hear this all the time. It's such a good point, Victoria, that
right. It's like, do we start taking chips off the table because it's so good right now? Like I've seen people do this across my career.
Well, we get these questions. It never feels like a good time to invest, because right now this is exactly what people are saying. Oh, well, it's had a good run. It's going to come down.
Yeah.
And then we're in that negative cycle. We're in that negative cycle, and people are saying, I'm just going to wait and see until it recovers.
Right. It's kind of on the other side.
If you're relying on down. Yeah, if you're relying on your emotions to dictate your investment returns or your investment philosophy or approach, it will never feel like a good time to invest. You will always be fearful. There's always a reason to be scared.
Totally.
Which is funny, because it's always a good time to invest. That's the whole point.
Yep.
Rabih, any other thoughts on that or anything else here?
Yeah, just to reemphasize Victoria's point about taking chips off the table, the action of taking chips off the table in its essence is neither like good or bad. The reason for why you're doing it is what matters. So if you're doing it because you think the market has had a run, which is a forecasting intention, then that is a wrong way to take chips off the table. But if you have a certain time horizon, or you've got a certain risk bandwidth that you are now has passed simply because equities have done well, taking chips off the table in the form of rebalancing might be the prudent way, but it's going to be depending on your specific case, your specific portfolio, and specific investment horizon.
Yeah, there's a difference between market timing and your personal timing. Don't get it twisted.
Well, and not only that, but to Robbie's point, we do this, right, where we have specific allocations and rules around our allocations for, let's say, our U.S. allocation and exposure to U.S. versus international versus bonds, like whatever that portfolio might be. And we this is what Rabih does all the time, right? He's tracking those allocations and doing a rebalance. So I love that point, Rabih, that this might be a reason to take chips off the table, but it's certainly not, Victoria, to your point, it's certainly not from a place of, oh man, it's had a good run, we got to get into cash. We've got to reallocate and rebalance some stuff, focus on the long-term time horizon that we have. So it's a really good distinction that you made there. Okay. So we've determined that it's not a little too quiet, or it is too quiet. I don't know. We just love sensationalistic questions.
Yeah, it's quiet enough for you to not worry about it, which is great.
Yeah.
If Robbie's not worried, no one should be worried.
Rabih is
Once Rabih starts worrying, then I'm very concerned.
I agree. So that's good perspective. Okay, wanted to jump to this next topic, which is, why does everyone feel poor? We've alluded to this kind of stuff before, and I'm fascinated by this. I'm always fascinated by not only the numbers that give us an understanding of how wealthy we are in this country, but also I just love the psychology part of money and how we approach money. So I found this article that was, I'll just give you the title. It says only 33% of millionaires consider themselves wealthy. So I was digging into it. And so there was a survey done by Edelman Financial Engines, big company. And they surveyed, I don't even know, they said, I was trying to find the actual breakdown. It was like thousands of people over the course of the summer. Anyway, the first thing they found was only 12% of Americans consider themselves wealthy. Only 12%. 33% of millionaires also do not consider themselves wealthy, which is kind of, this was interesting. So this was 3,000 adults over the age of 30 that were surveyed from June 12th to July 3rd.
Okay.
So before we jump into this any further, I just am curious your thoughts on just that top line. Like, only 12% of Americans consider themselves wealthy. Does that, Rabih shaking his head?
Dude, and Americans are like the richest citizens of any country. Like, I'm just putting on my foreign hat for a second. Whenever you say American for someone who's not from the US, they're like, oh, they're rich. And that person could be dirt poor or very rich. But from their perspective, everyone is rich in the US.
Mhm.
So to tell me that even in the US, only 12% think they're rich, including a third of the millionaires, is just
It's wild, right?
Blows my mind.
This is so. I love these topics with Rabih sincerely because Rabih brings such a different perspective than us for sure.
Yeah.
Being born and raised in the U.S., truly, because like Rabih, you do give that international perspective of saying when you see these types of surveys and what you just said, you're kind of like, you guys have no idea. Like truly, and it just gives a really good perspective of a lived experience to say, kind of like you guys are idiots that you actually can think this.
Right.
By the way, really quick, so 3,000 adults age 30 or more from June 12th to July 3rd. It was 1,500 of the participants had a household asset or a household net worth between 500,000 and 3 million.
Okay.
So that was the survey. So half of the people surveyed. Which is wild that of all those people, only 12% said they felt wealthy.
It's wild. I just Googled some numbers just to give this even more objectivity. You're saying between 500,000 and 3 million.
Yep.
The US GDP per capita is $60,000. The rest of the world, the average global GDP per capita for 2022 is $12,000, around $13,000. So just like look at the difference, and this validates why non-US people looking at US, although that person could be thinking that they're not wealthy, having 500K is just blows the rest of the world out of the water.
Yeah, it's good to get that perspective. Victoria's got thoughts. I can see it, her ruminating.
It just it's the comparing game in it. And I don't know, I'm making a face just because I had a couple client calls this week where, those clients are doing more than fine. They're doing great. But because their friends are doing investment properties in Florida or California, all of a sudden they're like, well, I need to do that. And if I'm not doing that, then they're better off. And so when we've talked about this a lot on the podcast, how we think social media is just causing people to feel this way and compare. And so I don't know. I blame it on our ability to see others really well, right? Like just see how other people are doing what you're able to do, because sure, there's people who can do crazy things with their money in this country and there's people who can't. And I think the spread of that is what makes people feel like wealthy or not.
Yeah, I totally agree. And you're alluding to something that Daniel Crosby referenced at our summit and that we talk about a lot, which is this idea of being careful with your reference group.
Yes.
Because I think it's naive for us to sit here and say, like, stop comparing yourself to others. It's like we are a status-driven people. Fair. That's humans. Mm-hmm. But this is the lesson that I have to learn of saying, like, it's not helpful to tell people, don't compare yourself.
Yeah.
We can remind each other, like, don't let it get out of control. Certainly turn off social media. I promise you your life will get better. But if you're going to compare, first of all, be aware that you're doing it, and then be aware of who you're comparing yourself to. Who's your reference group? Mm. And even further, if you're depending on who that reference group is, do you actually know their lives? Does it actually, like, do you actually know the details of their lives? Like,
the
again,
trade-offs they had to make to do this.
Or what are you referencing? Are you referencing the car they're driving, and you're driving a what you perceive as a worse car, and so that you think that they are wealthier? How about take that a little bit further? That just probably means they're in more debt. That's all it means. That they're spending more money than you. It doesn't mean their life is better or they're wealthier. So I think understanding those things, taking a step back every once in a while and being like, who am I comparing myself to, I think is a really critical part of this. I think asking yourself the right questions, I think is really critical. Like, am I too focused on like a specific dollar amount? I think asking yourself better questions can be helpful as well. Rabih, what are your thoughts? It looks like you've got more on here.
You guys, I think I think I'm sourcing it correctly, but I think it was in Morgan Housel's book, Psychology of Money, where he said wealth is what's hidden and it's not what is shown. And when you were talking about people having the nicer car, it just simply means that the wealth disappeared and now it's showing. So
Yeah, exactly. He says wealth is what you don't see,
yes.
which is so true. Status is everything else is just status.
Yeah, because it's not cool to be like, do you guys know what my brokerage account balance is at? Right? I can't show that off in physical form, but I can show that off in physical form with a car or a house, so you can see this. But I don't know. Be more mysterious with your wealth. Just keep it a little secret, you know?
No, I think a key word here is be more intentional. I think we talk about that a lot. Taking some time to understand your purpose with your money, understand the intentions behind your money. I think I can safely say this. For most people, like, things are not going to bring you happiness. Things are going to bring a lot of emptiness. I think experiences, if you just were going to say like a rough kind of like one way or the other, if you're focusing more on experiences than things, I promise you, studies show this, and I've seen this with clients, I've seen this with my own life, you're going to be far better off. But the other part of this I wanted to hit really briefly, the other part of this article I thought was interesting, maybe give us some good reference to or a good perspective, is how much money would it take to feel wealthy? So part of this survey, they did, so 65%, I guess, let me ask you this before we jump in. What would you say? Not maybe for yourselves, but just what would you think people would say? What's the baseline number? So 65% of people said a number. What do you think that number is?
How old are they?
I believe it's the same group, the 30.
It was like 30 to...
I believe it was over 30.
Oh, man. In today's economy?
So, by the way, this was, they called it money in the bank. How much money in the bank, which let's just say that's a way of saying like assets, investable assets.
Okay.
What do you think the number is?
I love how I told you guys I hate guessing games.
And that's all we're
doing. You
doing.
said we're going to do it again.
Yeah, okay. Okay, we won't go there.
Okay, I'm going to guess like 3 million.
Okay, Rabih?
Yeah. 4 to 5.
Million?
4 to 5? Okay.
Oh, 4 to 5. I thought they said 45
$45
million.
million? Okay. $45. So 65% of those polled said they would need at least $1 million in the bank to consider themselves wealthy. 28% of those surveyed said $2 million or more. 19% put the bar at $5 million or more.
Huh.
So
I'll just say, can you tell we work with dentists?
Well, that's exactly. So I think if you were to survey dentists, I think that $5 million
for sure
would be. And to be honest, that's the number we would say for most dentists if you're trying to be financially independent.
Yeah.
5 to 6 million is a pretty good number to be shooting for.
Yep.
But that's, again, just one more point here. There's a huge difference between saying financially independent and financially free of stress, or having harmony with your money, or being at peace with your money. I'm nowhere near that number of financial independence, but I can safely say I am very, very much at peace with my money.
Yeah.
Because my system is running. I know where I'm headed. I know I'm going to get there. And I'm also not like feeling like a slave to these things. Like, I think there's a way you can get there far sooner. And this is, I think, one of the biggest misconceptions in our industry of people think I'll only be happy when I get to that independence figure. And that's, I think, a huge problem.
Yeah, that's my next thought, because if you have a specific number in mind, I guarantee you once you reach that, it's just going to get pushed up again. Like, I've never seen it the other way where it's like, oh, cool, this was my number. I hit it. Now I'm happy. Never seen that. Not once. So it's just not a way to form a goal, or rather like work towards a goal. It's just going to keep bumping up.
Yep.
And that's frustrating.
True. Yeah. Rabih?
No, I loved all you guys said. It's hitting home.
Oh, look at this. Give it some perspective. Last thing on this.
Just my finances after.
Rabih's like these dang Americans.
Idiot Americans. Again, it is so good, I think, to look at global numbers and I think get a perspective sometimes. Other thing on this really quick. So how much money we talked about, kind of net worth figures. They also did the survey around income figures. So 58% of those surveyed said they would need at least $100,000 in income to not worry about everyday living expenses. And then a quarter, so about 25%, said they would need to earn more than $200,000 to feel financially secure. Again, you take this to dentists and you probably double those figures.
Yeah.
I would imagine. So we're a little bit skewed on the upside. So
yeah, we should do our own survey with just dentists.
We probably should.
That'd be cool.
Because I think, and again, I like seeing this kind of stuff to give like dentists out there some perspective of saying 60% of people surveyed said they need at least $100,000. I think if you said that to dentists, they'd be like, okay, I'm poor.
Yeah.
Like that's poor.
Right. So
I think just giving some perspective there. So
yeah.
Why the question being, why does everyone feel so poor? I think it's just, I think you hit it on the head, Victoria, kind of the comparison aspect of things.
Yeah.
And
if
no
you're
matter
feeling
what,
poor, go on a walk and turn your phone off. Like,
one thing I'll do with people sometimes, whenever I get, complaints or people talking about stress or whatever, I try to give them a little perspective and I'll say, let's look at your tax bill this year, just your tax bill. And this works really well for people that are like mid-career, right? Let's say they're in their 40s. You say, let's look at your tax bill this year. And then we'll look at it and I'll say, do you remember how much you made in your first job? And it's usually their tax bill, I have seen in most cases, is at least double.
Yeah.
Is at least double what they used to make. So it's just trying to give some perspective of like, you're the person you were 10 years ago would probably be rolling their eyes at you for complaining about where you're at today, So it's again, this is why we talk about tracking progress being so critical and taking a step back and reviewing to give yourself perspective. So any final words on any of this, guys, before we finish the last topic here? Okay. Victoria, what can Roger Federer teach us about stocks?
Yep. So I have a lot of tennis. I have a lot of tennis puns today, and I'm really excited. So I really don't want to make a whole racket about this, but I really love if we talk tennis. We get any of that?
Yeah.
Do you guys know I'm like low key a really huge tennis fan?
I didn't know that, but I don't know what you love more. I don't know what you love more. Talking about animals or dad jokes?
Dad jokes. I'll give it to dad jokes.
Probably dad jokes.
It's close, you guys. It's really close. I have 2 different books that are just dad jokes that I own.
Yeah. Okay.
I did spend more time creating these puns than I did researching this topic.
I'm just going to call you out because I'm looking at the doc right now. Insert funny tennis pun transitions into Victoria's topic.
I also have an outro, so.
Okay, perfect. We're ready.
Well, and I couldn't put the puns in the notes because you guys would have seen it, and I need to have that like effect.
Yeah, love it. Yep.
Okay, cool. We'll get into it. So, DFA, Dimensional, who we use for our investment management, put out this video about Roger Federer, or really tennis and the stock market, and it was a very interesting comparison. So Roger Federer, we know who he is, right?
What are the Rabih?
Unlike Pesto, I know who this is.
Yeah. One of arguably
maybe
the greatest.
Roger is a little more famous than Pesto, but
yeah. Arguably the greatest tennis player ever. I think Djokovic and Nadal would have something to say about that, but he's top 3 tennis player of all time.
Yep, totally. So over his 25-year career, he won 103 single titles, but he did that by winning only just a little more than half the points he played. I didn't know this. I just assumed he 100% won every single round, but they made a really interesting comparison, which was he just won a little bit more than half the points he played, 54%. So just that tiny little margin over a 25-year career, and you guys are probably seeing where I'm going with this, had compounding effects. So 54% points won, 76% sets won, and 82% matches won. I don't know what a set and a match is, to be completely honest with you. I know nothing about tennis.
I thought you were a low-key tennis fan.
I'm not. I lied. I'm a fake fan. I would like to go to the Open one day because Taylor Swift and Travis Kelce were there. So Anyways, so there is a similar pattern in stocks. So since 1990, the S&P 500 index has just has closed on slightly more than half the days it's trading, and actually the same exact percentage. So days up are 54%, so the same as Roger Federer. And again, that small little margin has compounding effects. So 54% days up, 72% quarters are up, and 82% of years are up. So it's really funny because those data points line up very closely. And that was probably very intentional on Dimensional's part, but I just thought that was so fascinating. And really the whole point of this is, like, on any given day in the stock market, it's basically a coin flip. And just slightly more days are up, but that slight little margin has such massive compounding effects. And that's really why we very much push stay invested in the market, because the thing with Roger Federer, I did a little bit of research. Like, what made him so successful too is he won very key matches, and that also has similarities in the stock market, because if you miss like top 10 days or very key points in the stock market, your portfolio will be far worse, especially if you continue to do that. So the really a huge reason why we tell people to stay invested is because nobody knows when those key days are going to be. Nobody. But if you miss them, even if you miss 5 days, there's data all around this. Even if you just miss 5, 10, 15 over a long period of time, you will hurt bad in your portfolio versus if you just stayed and you participated in those key days. I will pause there.
I love that. Rabih's got thoughts. He's been nodding aggressively.
No, I love it. That edge goes a long way. There's even an argument for, oh, this doesn't work. A tennis match, you know how much you're going to lose, you know how much you're going to win. Kind of the magnitude of the swing to either side is determined. Whereas in the stock market, it's 50% up, 54% up, 46% down. But what is the magnitude of the up? What is the magnitude of the down? And what's the swing in each? Regardless, even with us knowing that the stock markets, when the stock market goes down, it goes down at a much bigger magnitude than when it goes up. We know that. And still, because of that edge, the stock market on a long-term horizon converges to a long-term average of 8 to 9%, well, depending on the index you're looking at. So it is wild how far that edge can take you, even if you are in a situation that's not proportionate, and the losses can be bigger than the gains.
Yep.
Yeah, this is, I mean, I think it's crazy when you see those lined up, the point to the day, the set to the quarter, and the match to the year.
Isn't that wild?
Almost within exact percentages. Like, yeah, DFA, like you said, the article, and also shout out to our very own Jake Elm. I know he did an article on this exact topic a while back, but yes, they took advantage of it to get a point, to like drive a point home. But it still remains, the numbers are the numbers. Like, that's pretty wild how that lines up.
Right.
So, Victoria, I want to come back to the point you made that is so critical, which is, and I've heard Roger Federer in speeches say this, that the key was he's for him to not only have that edge, but he won those critical points when it was required. And I want to just highlight that of what you said of, like, you've got to actually keep playing the game. You've got to stay invested to be able to take advantage of. That's the equivalent of him winning those critical points that put him over the edge. The equivalent of that in investing is staying in your seat when things get crazy.
Yeah.
And so I love this. I love these analogies, and it's crazy how these everyday life type things translate so much to investing. So love this. What any final thoughts on Victoria? I know you've got some nice outro puns for this.
Well, I have one joke and then some outro things. So
Hit us.
I made this one up. You ready? So you guys
Wait, this is a Victoria original?
This is a Victoria original.
Okay. Tell us.
Get ready. Do you know why tennis players do really well in the food industry? Because they're excellent servers.
Rabih hated that so much.
Yeah, I don't think he's going to speak to me the rest of the day.
He
But-
just put his hand down over his face,
Face palm.
face palmed himself.
Yeah,
Good
no,
thing
I
we're
think,
heading into the weekend.
Yeah.
no, I think I really liked this comparison. And if you're on our private Facebook page, I think I posted the video that you can watch that dimensional put together. And if you're not on that, you can request to join it. But really, with all of this, I mean, I just had a ball talking about tennis and investments with you guys, and you really do just reap what you serve here. And when it comes to this, the ball is really in your court. So get invested and stay invested.
I'm
both-
aching. I'm physically aching.
You guys like that?
He is so freaking mad right now.
Ball is in your court.
Well, Victoria, thank you so much. You aced that one.
Oh,
Yeah, I
okay,
loved
okay.
it.
I love this.
Okay.
I love this. Okay, no, I really do love this. I really do love this topic. I have no puns to reiterate that, but I just think the final, I guess, Victoria, the final note you have here in the doc, I think, kind of is the point. You want to?
Oh yeah, I forgot about. I got so tied up in my.
You were so excited about your puns.
I know. I can't put all my rackets in one basket. Here we go.
I know.
Rabih is suffering. Okay, I'll stop. I promise. That was the last one. So in the video, they say you don't have to win every point to be a tennis champion, and you don't have to win in the market every day to have a successful investment experience.
Love
And
that.
scene.
And scene. I think the one point here too, from a practicality standpoint, that we want to share and remind people of all the time, which is, as you can see here, the further out in time you go, the more your odds are increased of having positive days.
Yeah.
And if you think about this psychologically, to like stay invested, you kind of have to take advantage of your psychology and like kind of hack your brain a little bit. So one way to really do this, I think, really, really effectively is how often, like the rules you set for yourself of how often you're going to check your investments. If you're checking every day to this point, you're going to basically have a coin flip of having a positive or negative day. But if you go out to a quarter, you're increasing those odds by almost 20%.
Yep.
If you're going out to every year, you're increasing by almost 30% that you're going to see a positive. So again, just keep that in mind of how often you're checking and obsessing over, over your investments and over your returns. That's going to have a truly an impact on how you stay invested, because the only thing that matters, I shouldn't say the only thing, the most important thing that matters with any investment strategy is having one you can stick with. And a big part of that is psychology. So,
definitely.
Okay, Rabih, you any final words, or you're so physically in pain right now from the puns and jokes?
I'm done.
He needs workers' comp.
Rabih's like, I have to go. We have to be done. Okay. Well, Rabih, thank you so much for being here and enduring the puns from Victoria. Victoria, thank you for the puns. Those were awesome. Everyone, thank you for listening. If you want to talk to us, you want to share your story, see how we can help, please go to dentistadvisors.com, click on the yellow book free consultation button. We would love to talk to you. But for now, that was our 2 cents. Till next time, have a good weekend. Bye-bye.